Welcome everyone to another edition of our sovereign credit rating discussions. Now it's the opportunity to discuss about Georgia. Our previous event was Uzbekistan. As I see, many of the registered participants and attendees were there. Given the current situation, we have to change these types of events that we hope before we have them live to this webinar session. So hopefully it works well. So thank you all for attending. I also want to thank obviously our speakers for joining us. Today we have the pleasure to have Anna Kavtaradze. She's the director of the Finance Department of the Bank of Georgia. And she is also a member of the Executive Committee Banking Commission of the ICC Banking Commission. And today she will be talking about post-COVID-19 challenges and opportunities for trade and supply chain finance. I'm also delighted to be joined by Vasil Revishvili, who is partner and CIO at Thales Investments. And today he will make a presentation about bottom-up investment approach, a key to sustainable finance. And finally, also a pleasure to have Otari Sharikadze. He's managing director at Galt and Taggart, and Otari will be speaking about post-COVID opportunities in the Georgian economy. The format of the webinar, basically all of us starting with me will make our presentations. In the top right corner, you can see there's an icon that says questions. So you can post your questions there during the webinar, and at the end, we will dedicate around 10 minutes for a Q&A session. If we don't answer all of your questions or you have additional questions after the webinar, you are free to contact us in a later date. Okay, so let's start. So I will be talking about a bit of what RAEX-Europe does, the origins. Then I will step into the credit rating of Georgia. As many of you already know, our format, we talk about the positive factors, restricting and neutral factors, negative, stress, and then our sensitivity assessments. So something about RAEX. RAEX Group has been around for around 20 years. We have experience in credit ratings and also analytical products. The agency here in Europe is active since 2013, and since 2015, we have been accredited by ESMA, which means that all assets rated by us are useful for regulatory purposes in the European Union. Also, as of April 2018, we received ECAI status, and also we received the mapping from EBA. This mapping, as you can see in the picture, is useful to compare our rating scale with other big three rating agencies. And also it's very useful for commercial banks to calculate internal capital requirements in case they own products or assets as a classes rated by us. So our activities, we do obviously credit ratings, sovereigns such as this one. We do also regions, banks, insurance companies, non-financial corporates, and soon we'll be introducing the methodology of non-bank financial institutions. Besides credit ratings, we also provide products in the sustainability sector. These are ESG ratings. We also do green bond second opinions, social bond second opinions, sustainability bond second opinions, and many other services in regards to sustainability. We're quite experienced also in this field. We also organize business conferences and presentations here in the European Union. As many of you already know, we have an end-of-year event every year. We'll keep you informed about this year due to the current situation, but this is also something that we do. And finally, we provide industry and socio-economic research. Okay, so let's start with the credit rating. Our latest revision was at the beginning of April, where we decided to confirm Georgia's credit rating at BB with a stable outlook. By this time, we did not have the full picture of the coronavirus situation. Actually, right now, still not very clear for a lot of us. Everything's changing very quickly. However, right now, we have more data to work with and to project. And with this data, we have not decided to do a new review of Georgia, so we will stick with our calendar, and with the next review, unless something extraordinary happens, the next review will be on the beginning of October. Okay, so let's start with the positive factors. The first positive factors is the fiscal deficit, which has remained stable in 2019 and in previous year. However, due to the current situation, is set to widen in 2020. As we anticipated in our previous reviews, the fiscal deficit increased up to 1.8% of GDP in 2019, as we saw an important hike in capital expenditures. This climbed by around 35% year over year, while also social benefits saw an important increase this year. On the revenue side, we saw a solid hike of around 9.2% due to strong goods and services tax revenue, as well as income tax collection. In fact, this strong growth in revenues was what allowed the government to have an important expenditure in capital. In addition, the augmented fiscal balance, which includes budget lending, shrunk slightly to around 2% of GDP. This is mainly a result of a decline in budget lending. Going forward, even though we anticipate fiscal discipline from the government to continue going forward, recent measures, obviously as a result of the coronavirus crisis, we expect that will expand the deficit to around 8% of GDP. This is due to the measures announced by the government, which will account for around 5 to 7% of GDP. This depends on the obviously severity of the situation going forward. The measures presented by the government, as you can see in the table below, are as follows: mainly COVID-19 related healthcare supply and services, subsidies for businesses and commodities, also subsidies to pay for utilities, direct transfer to employees in the private sector, direct transfers also to families, and also healthcare investments. The other positive factor that we observe is the quality of the fiscal policy. Even though we have seen, as you can see in the graph, a slight widening of both the deficit and the augmented deficit, we still consider that the government has complied in general terms and has been in line with the accord that they have with the IMF under the framework. Therefore, we still consider the fiscal policy quality to be adequate for the rating. So the next positive factor is the solid economic growth so far for Georgia. Again, in 2020, we see an inevitable contraction, as we see in other countries due to the current situation. However, in 2019, the economy posted a strong growth of 5.1%. This is compared to a metric of 4.7% in 2018. So this has been actually growing quite solidly. The retail and real estate sectors showed a solid increase. They increased by 9% and 6% respectively in real terms. And on the other hand, household consumption remained stable throughout the year and posted an increase of 12.8%. While we saw government spending go down towards the end of the year in 2019, we still saw overall solid growth of government spending in the year, as it increased by around 9%. Going forward, however, we anticipate the economy to contract by about 4% in 2020 as a result of the pandemic. In our view, the economy will be mostly affected by the lack of tourism, as well as by the closure of the economy due to the current state of emergency in the country, which has already caused a decline in domestic consumption. In fact, preliminary figures by the government, we can already observe a decline in GDP by 16% in April 2020 and a decline in exports by 11.9%. However, the government of Georgia has already received aid. The IMF has provided, under the extended fund facility arrangement, $200 million. The World Bank has also committed 45 million euros. And the European Council has also provided 150 million euros. On a positive note, COVID statistics in Georgia have been encouraging, and actually there has been a decline in the number of active cases, which has translated in the government already starting to reopen the economy earlier than anticipated. In fact, starting on June 8, all the restaurants and hotels will reopen, and this is roughly around 1 month ahead of schedule. So if many of these measures are lifted ahead of schedule, ahead of the plan that the government has, then obviously all of our projections, all the projections that we have, for example, this economic construction, will probably be lower than anticipated. And the next positive factor is the so far stable FDI inflows, net inflows in the country. In 2010, we estimated to be around 6% of GDP, which was mainly propelled by the financial and energy sectors. However, as many other factors, it's set to decline in 2020. We expect a decline of around 1% of GDP. So our next positive factor is the state of the banking system, which is solid. However, financial dollarization is still high. By the end of 2019, we expect domestic credit to have stood around 78% of GDP. This is an increase of around 7 percentage points as compared to 2018, as we can see in the graph in the red bar on the left. However, again, as a result of the pandemic, we anticipate this metric to decline by around 4 percentage points and to stand around 74% of GDP, as we expect lending to grow 7% in nominal terms. This is compared to a growth of around 20% in 2019. However, the recent reduction of the reference rates by the Central Bank of Georgia could help alleviate this and provide slight boost to credits in the economy. In terms of the loan structure, the share of corporates and individual entrepreneur loans stood at 55% of the total portfolio, and the share continues to increase. And it remains larger than that of individual loans, which is at 45%. This is actually a very positive note, as it reflects increasing financing to the actual productive sector of the economy and lower financing to only consumer loans. Moreover, we have seen, as we can see in the black line on the graph, the level of growth in mortgage loans to have also declined. Going forward, as I already mentioned, we expect the cut of the rate by the central bank to provide a boost in lending. However, not as much as needed. In terms of soundness, the banking sector remains solid. As of the end of 2019, the NPLs to total loans ratio stood at 1.9%. Capital adequacy was 19.5%. And despite the slight decline, profitability remained positive, as ROA was 2.5% and ROE 20.3%. However, as we can see from the graph below, we can already see some metrics, some signs of deterioration in the system. Capital adequacy already posted in the first quarter a figure of 17%. NPLs increased just slightly to 2.2%, and ROA was also negative at minus 7.1%. We expect the sector to remain under stress due to the current situation, and mainly the fact that dollarization remains high. The fact that dollarization remains high could have a direct impact on all of these metrics, namely capitalization, earnings, and asset quality. Therefore, amidst this pandemic situation, the central bank has already provided some measures, such as banks can use capital conservation buffers. Previously planned increases in capital buffers have been postponed, and banks can go below 100% of the liquidity coverage ratio, among other measures. The next positive factor is the favorable quality, in our view, of the monetary policy. Georgia has a floating exchange rate regime, which is optimal to absorb external shocks, especially in situations such as this current pandemic, and a monetary policy based on achieving price stability, as it has adopted an inflation targeting framework. However, as we can see from the graph in the left, which compares the refinancing rates and the market from the central bank and the market lending rates, we still can see that there is area of improvement in the transmission mechanism of the monetary policy. And this, in our opinion, would largely depend on the de-dollarization measures and how the lari becomes the selected currency in terms of loans and deposits in the economy. In terms of price dynamics, inflation picked up substantially in 2019, up to 7%. This is already 4 percentage points higher than the target of the central bank, which stands at 3%. However, we consider this increase was mainly a result of one-off effects. And going forward, we expect the depreciation of the lari to sustain inflationary pressures in the country. However, also lower commodity prices, a weak domestic demand this year, and the removal of one-off effects will help the inflation to come down to the levels targeted by the central bank. So as we can see in the graph, by 2021, we expect inflation to be on target. In regards to reserve, as predicted in our April report, despite the central bank having mentioned at the beginning of April, end of March, that the policy would remain tight, we anticipated that this could rapidly change in case this the coronavirus effect gets stronger, and this actually already changed. A couple of weeks ago, the central bank trimmed the reference rate from 9% to 8.5% in order to help propel credit to the economy and the economy in general. In regards to reserves, despite the central bank's plan before to pile up reserves and build up buffers, it is actually now using these reserves to stave off the lari depreciation. And as a result of the pandemic, and they have already intervened in the currency market this year, which has supported the lari and halted a continued depreciation since the end of March 2019. So actually right now we can see that the lari is more, after this depreciation, is more stable, and also reserves have been more stable. It is important to mention that the free float in the country remains, and these interventions by the central bank are only to smooth the shocks. But the regime of free floating exchange rate is still part of the monetary policy. We estimate that around $160 million have been already used in the foreign exchange markets interventions. So now we're going to talk about restricting or neutral factors. First of all is the level of government debt, which has remained adequate. However, again, as a result of the pandemic, we expect it to increase. So in 2019, it stood at around 42% of GDP. However, as mentioned previously, the government has committed to spend around 5 to 7% of GDP to reduce the impact of the pandemic. And thus, we anticipate an increase to around 63% of GDP. This does not only reflect the pandemic measures, but also reflects the lari depreciation, as most government debt from Georgia is denominated in foreign currency. The structure of the government debt remains mixed. As of the end of 2019, 4.4% of GDP was short-term debt, and short-term debt also accounted for around 10% of the total government debt. However, this was well covered 5 times by international reserves and remains at favorable levels. However, as I just mentioned, 80% of government debt is denominated in FX currency, which poses a repayment risk in case of the strong currency depreciation. At the same time, this is partially mitigated by the type of creditors from the Georgian government. As we can see in the graph to the right, 73% are multilateral creditors and 19% are bilateral creditors. Most of these funds are provided in concessional terms, and only 9% comes from the Eurobond. In terms of the public debt service profile, it remains quite smooth. We estimate that it's averaged around 6 to 7% of GDP, and the Eurobond comes due in 2021. However, the government is already planning to discussing financing options for this. Other restricting factors are the GDP per capita in the country, which according to regional peers is adequate. However, it's still quite low as compared to global peers. The banking sector concentration remains quite high, at around 77% in the top 3 banks. These, on one hand, could affect competition, but on the other hand, it makes the system a bit more stable. And finally, institutional development in Georgia remains moderate. The country has an HDI index of around 0.69%. And while most governance indicators have improved slightly, political stability remains one of the main challenges for the country. However, on the positive side, conditions for business in Georgia are quite favorable. They are ranked 7th out of 190 countries in the Doing Business rankings published by the World Bank. Now let's go over the negative factors. So basically the main negative factor for Georgia is the external position, the external exposure. It remains the main factor affecting creditworthiness. Despite so far having shown resilience to external events, Georgia has still external weaknesses. The trade deficit decreased slightly to 8.8% of GDP, and also the current account shrunk slightly down to 5.1% in 2019. However, both figures remain quite wide, which shows the country's dependence on imports, tourism, and foreign inflows in both terms of remittances and investments. Due to this substantial external exposure, we believe that the coronavirus crisis could have a marked impact on these metrics. We anticipate the trade deficit to widen up to around 13% of GDP in 2020, as the exports of goods and the receipts from tourists will see a substantial decline. We also believe that imports will decrease, however, at a slower pace. While the current account deficit will stand at around 11.3% due to the expected decline in remittances. Moreover, as I already mentioned, currency depreciation will make cost imports to be more expensive and exacerbate inflationary pressures. Finally, the external debt of the whole economy remains high, and as it stood at around 114% of GDP by the end of 2019. Other negative factors that we consider is the amount of contingent liabilities. These mostly stem from inefficient and unprofitable state-owned enterprises, and also power purchasing agreements, which are mainly attributed to hydropower companies, and these have attached government guarantees. These remain quite elevated, and the risk of materialization is there. The other negative factor is the level of unemployment, which is at the end of 2019 was 11.6%. And obviously, due to the current situation, we expect it to increase substantially during this year. Finally, the stress factors are, as I already mentioned, the financial dollarization in Georgia, which was equivalent to 62% in terms of deposits and around 54% in terms of loans. And also the political risk stemming from the unresolved conflicts with Russia. So finally, I will talk about the sensitivity assessment. So basically, these are the conditions that we believe have to be met in order for the country to be upgraded or downgraded. In terms of an upgrade, a decrease of the external exposure by reducing the level of FX government-denominated debt would have a positive impact on the rating. Advancing the dollarization measures, this would be also important to alleviate pressures on the banking system and to alleviate volatility. Increasing national savings and also buffering up international reserves and further developing the productive sectors of the economy, so Georgia can become less reliant on imports. Another factor is a substantial reduction in the amount of contingent liabilities, which would reduce the overall government debt. Factors that could lead to a downgrade are the strong negative impact from the coronavirus crisis, which would negatively affect the exchange rate, causing asset deterioration in the financial system, and a reduction in international reserves, as well as economic volatility. This factor is already taking into account, or sorry, it does not take into account what we're already expecting. So if these materializes outside of what we're expecting, then this could lead to a downgrade. However, in 2020, 2021, we'll already see a recovery in most of the factors in the economy. But if this continues deep into 2021, then this could lead to a downgrade. Finally, the deterioration of the fiscal position by widening the fiscal deficit and increasing government debt, including the contingent liabilities materialization, increasing the spending needs due to the coronavirus crisis. So that's it from my side. Thank you very much for your attention. And now I will leave the floor to Vasil, who will continue with his presentation. So Vasil, please go ahead.
Sure. Can you hear me? I guess yes, because I see this mic bar running. Excellent. Good morning, ladies and gentlemen. So basically, I structured today's presentation rather as a case study, if you like, of how potential investor could capitalize on opportunities that Georgia gives today, and even like taking negative factors that sector talked about, turning them into opportunities, if you like. Okay, so the basic, if you like, investment strategy that we are using. I will talk about our fund later on, is the bottom-up approach, hence the name of the presentation. Why? Because we believe that generally like top-down approach, that means like investing across like all the sectors, companies or instruments, or if you like the structures in frontier markets that we are focusing on, is not as, if you like, lucrative in terms of opportunities as the bottom up, because like these sort of markets, frontier markets, especially Georgia, really give some diamonds, if you like, of the corporate world that offers excellent risk return profile. Okay, basically we are running. Our name is Thales Investment, as presentation says. That's our company established in Georgia. We run first ever, if you like, Luxembourg fund focusing on Georgia. Okay, even though like it's called Frontier Senior Incomes, because our mandate includes all the frontier markets where we have expertise. But currently, as I said, because Georgia is probably the best destination for this sort of instruments, like 90% of our investments is in Georgia. So we are first ever, if you like, Georgia-focused Luxembourg fund. Not only first, but still the only one. And we are one of the few funds focusing on the senior loans, because as you might know, like generally funds are trying to be more on the if you like listed companies side, both on bonds and equity level. We risked, if you like, and we tried to overcome the technical difficulties of setting up the fund, which is focusing on the loans, and we succeed. Okay, so as I said, we are Thales Investments. We are based in Estonia. It's a team of 2 investment managers, if you like, front investment managers, plus like 6 back office, which includes like risk management, compliance, etc. I will not, if you like, bore you with these details. Okay, what we are offering to our investors, it's 3 months LIBOR plus 6% gross. Well, LIBOR is gone now. it's close to 0, so it's like around 6.5%. We invest hard currency only. Well, it's not because we don't trust, if you like, the local currency. Well, yeah, during 3 years of our operation, we operate, our fund is 3 years old. We still thought that local currencies are slightly overvalued. Well, now probably we could like start thinking about, like local currency movement. However, again, well, that could lead to some certain technical difficulties, as I said, like on the Luxembourg side, because the custodians have several problems. But we are looking for the ways. Oh, okay, and obviously we are CSSF regulated, that is local, if you like, authority for financial sector supervision, and we are obviously like scrutinized by the auditors every year. Okay, but that's more of an introduction. The instruments we are focusing on, even though, like I mentioned, we are senior debt. Let me like go through our mandate. So basically, we do senior loans. Okay, and the reason why we focus on them is well, in frontier markets, as you know that, and Hector also mentioned that capital markets are still underdeveloped, even though like people like Otari, who will present later, and Anna, who will present later, do their best and succeed in improving the situation in capital markets. It's still underdeveloped. That means that access to capital for many good and good credit rating companies, I mean the internal credit rating, is still limited. Therefore, the only choice is to approach this consolidated, if you like, banking sector. Yeah, right. Where as the sector said, competition is not huge. However, well, to my taste, if you like, having no, if you like, diversification in banking sector is emerging markets is rather plus than minus. Okay, because of pluses of, if you like, the stability, price setting, etc., etc. Anyways, these companies, I mean, they need to go to banks. So obviously, since they don't have alternative source of financing rather than bonds, if you like, but they're still limited, they pay higher yields. And the volatility of these instruments that is alluring to, if you like, institutional investors who don't like to see volatility on their bonds or on their books is very limited because it's not traded. Okay, and finally, loans are extremely interesting, especially in the periods of what we see now, right? Post-lockdown crisis. Obviously, some of the companies have short-term, I insist, short-term problems with cash generation. So therefore, like, loan structure gives the lender opportunity to, or the borrower to opportunity to do the restructuring. That means like it's win-win situation, obviously, because it that limits defaults, right? Obviously, on the bond side, like current situation would be a disaster. You can't restructure bond, so if bond defaults, it's default. But on the loan side, as I said, like restructuring really helps in maintaining, if you like, healthy balance sheet. Okay, on the fund side. And finally, it's collateralized. If the worst situation happens, you have strong collateral to if you like, do some recovery on. Okay, so that are the reasons we are focusing on the loans, or in general frontier markets, and why Georgia today is potentially the best country in terms of, if you like, risk return on these instruments. Okay, well, if we measure risk return as, for instance, net interest margin divided by cost of risk, since, well, we don't really have like capital markets, as I said, to do some volatility of other measurements. So the best measure and the, if you like, best audited measure, if you like, is probably net interest margin divided by risk. So Georgia enjoys like around 5.7, close to 6% net interest margin post-COVID, probably, with pre-COVID cost of risk of 0.5%, which will probably increase now temporarily, but still, like, the ratio is excellent. Okay, so the other instruments we have in our fund is bonds. We don't have it from Georgia. We have some Estonian bonds, but the mezzanine instruments. Okay, again, it's the loan, but it's not senior. It's more like something in between equity and senior lending, right? Why mezzanine? Because mezzanine offers a fantastic yield. Okay, again, mezzanine is equivalent to bonds. Probably mezzanine financing is needed for the companies that cannot tap the bond market. They are not big enough, or they are not like corporate governance wise, they are not ready to issue the bonds. So they try to seek for mezzanine instruments, and therefore yields are like probably 300, 400 basis points, even sometimes higher than the bonds. Okay, and finally, as I mentioned, like our mandate includes the FX instruments, the foreign exchange, which we still do not do, because, like as I said, like set aside the technical difficulties, we believe that emerging market currencies were overvalued, and now they reached if you like, zone where they could become interesting for potential investor. Our investment philosophy, I will try to like run through. Obviously, you can download the presentation and get all the details, because like my style of writing presentation is rather like textbook rather than bullet points. Sorry about that, but still. Okay, so the investment philosophy, I probably touched on most of the topics, but what I wanted to add is that the environment for investment in countries like Georgia is fantastic despite the risks. Why? Because like policy, even though like we are all still complaining about like all the governments, that's normal. That's another plus that we can complain about governments and don't go to prison. But even though like we believe that our government like probably has strict, if you like, monetary policy, it's still liberal in terms of worldwide, right? And this liberal monetary policy obviously results in higher inflation. Higher inflations results in higher yields. However, doesn't necessarily affect the risk, right? Obviously, another if you like approach in terms of investment philosophy is that we still invest in short-term, if you like, securities. We are still not if you like not ready, or our investors are still not ready to take the interest rate risk. I mean refinancing rate risk, because it tends to fluctuate rather more than desirable. So therefore, we try to capture only the credit spread. The positive credit spread, which is not justified by defaults, if you like, justified in reverted commas. But we still not trying not to take the duration risk. Therefore, we invest in short-term instruments. Okay. I'll skip fundamental investment principles. Well, I will leave these also up to you, because like it describes, if you like, rather technically, but could be interesting for some potential, if you like, interested parties, potentially interested in investing in similar instruments in Georgia. Let's describe the process of, if you like, the investment flow. Okay, the risk management wise. So first, we have like two types or even three types of risk management. One is the investment risk that is run by portfolio managers. That's our approach. So basically, before taking any deal, we run the company financials through the prism, if you like, of the internal credit rating. Internal credit rating is something or something similar to, if you like, bank scoring models that we developed internally and proprietary. So the next step is presenting, if you like, our funding to our risk committee, which is based in Estonia, and they run it, if you like, they check the pre-trading, if you like, do the pre-trading check on the compliance side, on the adherence to the prospectus side, on the financial side, etc. So, and then obviously we recheck the companies, well, at least monthly, but hopefully bi-monthly too. Okay, and finally, well, again, the structure of our fund, which could be interesting for some people, but I don't want to stop on that. Finally, this is what is the result of the approach we are utilizing, and that's where you can see where is the difference between frontier markets, particularly Georgia, and emerging markets. So you see the yields, if you like, on the screen on the left-hand side, you see the yields of the corporate emerging market bond index and the credit risk, if you like, in yellow, which results in this purple final yield, if you like, and then you have like emerging market bond index, which includes the local government debts. And this is our the next three is the yields and the credit risk on cost of risk, if you like, on our senior and mezzanine instruments. And finally, you see the yields achieved after, well, obviously, I mean, you can't eliminate totally credit risk, credit spread, but it's close to zero, because like so far, obviously, we had to do some restructuring on 2 or 3 names, most of them involved in the tourism and hospitality sector, but their cash, if you like, forecasts are very good. So far we had single default. We didn't have a single default on our portfolio. That's pretty much it on my side, I guess. Thank you very much.
Okay, Vasil, thank you very much for your presentation. So let's continue. So now we'll give the floor to Otari. So please, Otari, we're listening to you.
Hello, good morning, everyone. I hope you guys can hear me well. Vasil, Hector, thanks for interesting presentations. First of all, let me tell you a couple of words about Galt and Taggart. So Galt and Taggart is an investment bank in Georgia. We are one of the largest ones present in Tbilisi. We've been present on the market since 20 years now. So, and we cover 3 main activities. One of them is historic activities, obviously a brokerage. So we are by far the largest broker in the country, and I would say even in the Caucasus region. We have assets under management of around $450 million already. So it's quite a big amount for the region. So we are very actively involved in brokerage, and we trade on local, regional, as well as international assets. On the other hand, we have advisory business, or the investment banking business, which covers advisory, M&A, as well as DCM, ECM part. So as Vasil mentioned, we were and we are very actively involved in developing the capital markets in Georgia. Obviously, it's still on the preliminary stage of development, but we believe that there is a huge potential for the market to grow and to even take on the role of regional hub potentially in the future. And the last and very important part, which we are proud of, is our research team, which we've had this team for around 10 years already. So we cover not only Georgia, we cover the region overall. So we cover Ukraine, Georgia, Azerbaijan, Armenia, Uzbekistan, Kazakhstan. We regularly publish reports on macro coverage. We cover a number of sectors. For instance, in Georgia, we almost cover around 24 sectors. Even though the country is small, we see that there is potential in many small niche sectors as well. So obviously, if any investor wants to get any information about Georgia or the region, they can get in touch with us on our website, and most of our reports are free and available. And overall, we have around 6,000 clients who are subscribed to our mailing list, and they receive regularly updates on Georgia, on fixed income, on capital markets, and so on. So we're very actively involved in a growing company in Georgia. As for my presentation today, we try to focus more on post-COVID opportunities that are presented to Georgia. Obviously, the crisis has quite hit Georgia quite heavily, not only Georgia, overall in the world, but we see that Georgia has surprisingly well managed to kind of contain the virus. I mean, if in February or somebody would tell me that we would get to this condition today, I think none of us would believe. But fortunately, the country has managed up until today to contain the virus and got less hit than expected in the beginning of the year. So our presentation is made of three parts. So first of all, we'll start with existing economic structure and impact of COVID. We'll talk about sectors where we see growth in production capacity in Georgia, and we believe that the crisis could be presenting certain opportunities for Georgia to attract FDI. So if we go further, sorry. Yes. So in recent years, I mean, Georgia has been becoming quite dependent on services, as tourism has become actually one of the main drivers of economic of Georgian growth. Actually, tourism represented 20% of GDP already. So you can see that GDP, 80% of GDP is constituted from services, followed by industry and agriculture. So basically, being dependent on services means that the country is also import dependent, and we have very little goods export base. So if you look on the right side, you can see that our export, including the re-export part, is around 12.4%, which is very low, and it has been stable for years. So this is not due to current crisis or any one-off event. So unfortunately, this has been going on for the last 10 years. And on the other hand, if you look at the import, it represents around 45.6%, which is also flattish throughout the years. So this, I would say, is one of the main setbacks of Georgian economy, that we are very much service-oriented, and I think we need to kind of change the structure of Georgian economy in the coming years. So if we talk a bit about the shock that the country got through tourism, due to COVID-19 impact, was that we believe that the country will lose around $3.6 billion, which is a huge amount for Georgia, and the biggest part will be through tourism. So we believe that tourism will lose around 2.2 billion. Last year, the industry generated around 3.2 billion, and this year we were expecting this figure to be around 3.6, 3.7. So this is a very, very significant contraction for the industry, and this is the industry which is most hit. Sorry, the presentation jumped itself. So as I said, the economy will lose around 3.6 billion, but on the other hand, there are certain adjustments which will be naturally done. So the biggest part of the adjustment will be done through imports. We believe the imports will be reduced by $2.1 billion, and there are two effects on that side. One is the demand contraction in the country, as well as low price of oil. We are an oil importing country, so this is also a very important thing for Georgia. On the other hand, we see that Georgians who used to travel abroad, unfortunately, this year won't be able to travel, so half of that money will be at least spent in the country, so this is an effect of around $400 million. We see that National Bank of Georgia has been already intervening on the market, as Hector mentioned in his presentation. They are trying to manage certain spikes, so we believe that throughout the years, they'll intervene on another $300 million overall. And we would require additional $1 billion to fill in the gap. In these terms, I think Georgia is very well positioned, because in a very early period of the pandemic, the government started working with donor organizations, and they attracted much more funds that we require. So I think in terms of funding and external borrowing, the country has even sufficient buffers if the situation were to get worse. So in these terms, I think we will manage to balance the year, and hopefully 2021 will be much better. As for the impact on the sectors, we believe that there are three main brackets here. So there are certain sectors which were immediately hit and negatively, which are mainly industries which were related to hotels, so hotels, restaurants, shopping centers, which were completely closed, entertainment and transport. There were certain delayed negative effects, which were on the financial sector, construction, real estate, and other. And there is a third bracket, which we think that there is a neutral or maybe sometimes even slightly positive effect. Industries such as healthcare, e-commerce especially, which got a boost through COVID, and it's been growing quite well. And I believe that this is going to become a trend in the coming years. Agriculture, communication, and obviously local tourism, which will be, I think, if I can say, driver of tourism this year. Now, actually, the biggest question we've been asking at Galt and Taggart and overall is, does this crisis present any opportunities for the country? Basically, should we continue with existing model? As I mentioned, we are very much service-oriented and import-dependent country, or should we try to enhance production capacity and diversify further, considering that there is certain shifts in the world where we see that we are moving slightly from globalized world to more protectionism. There are certain messages of shifting supply chains, especially from China. So this could be something that could present certain opportunities for countries like Georgia. Initially we've analyzed. We've analyzed Georgia's import statistics. So on this screen, you can see that in 2019, Georgia imported roughly $9.1 billion worth of goods, out of which around $1 billion were re-exported to our neighboring countries. And we did the analysis in two terms. Basically, on one hand, we looked at the sectors which are mostly import dependent, and on the other hand, we looked at the corporate structure of Georgia, and we tried to identify certain sectors where we have capacity for production of new products or expanding existing production. So we identified at this stage two big sectors, which are construction and industrial materials, as well as food products. And we believe that only in these two sectors, there is a possibility of producing of additional 800 to $900 million worth of products. So we believe that there is a potential in existing corporate structure of Georgia, whereby certain support and policy measures, these companies could expand their production and not only substitute part of import, but become more export-oriented companies. So this is, I think, a very important policy that we recommend Georgian government to implement in the coming month as a post-COVID strategy. Also, I think it is important to mention that Georgia, throughout the years, has been accumulating benefits. We know that the Georgia has certain number of important competitive advantages, such as access through free trade agreements with certain countries. We have access to 2.3 billion market without any custom duties. We have one of the lowest tax burdens in the world. We have a low energy and labor cost country, low corruption level, favorable business environment. We are rated in ease of doing business in top 10 almost. So throughout the years, Georgia has been accumulating these benefits. And on the other hand, we considering global value chain relocation, we see that there are certain competitive industries which could be sources of attracting FDI, such as, for instance, textile. I mean, in western part of Georgia, we already have certain number of success stories where very big and very important brand names are produced in Georgia. So this is not something where we should start from zero, but there is already certain success stories. We can capitalize on this. There is manufacturing in automobile and auto parts. So we have already one factory which is starting to produce electric vehicles in Georgia. So we have production of pharmaceuticals and other chemical products. So this industry has been also growing throughout the years, and we believe that there is an additional potential in this sector. Manufacturing of home appliances, transport and logistics, business process outsourcing, which is very important. There are certain big companies like Majorel who've been moving to Georgia and working quite well here and expanding well. So we believe that this is something also this could be a very important sector for Georgian economy in the coming years. Overall, we believe that considering the globalization and the changing world now based on post-COVID world, we believe that Georgia should set up a certain roadmap in order to attract FDI. I think we should move decisively and generate certain bold messages and kind of position ourselves as a place where any investor could do business and explain to them the ease of doing business over here. So I think we split this roadmap in roughly 5 parts, which initially I think we do not need to invent anything. We should just try to identify a certain number of success stories. You can start with Ireland, you can start with Serbia, and certain countries who throughout the years have been implementing certain policies who could and achieving the FDI attraction. We could also look at Poland, who's been very actively attracting FDI throughout the years, and especially we could look at their case study of what they've done when during the Brexit crisis, where they tried to attract number of investment banks and in Poland. The secondly is that we should identify sectors which have real potential of attracting FDI, and I mentioned certain number of them on the previous pages. Also identify a certain number of international companies with whom the government needs to start communicating right ahead. I mean, I think there is no time to lose. We believe that we saw during the COVID that investors left emerging markets and they went back to more developed markets where they were, and now they are looking for opportunities to come back. And I think the world will become much more competitive, and most of these emerging countries will start fighting for investors. And I think it will be much more competitive than it was before. So I think the countries which start acting early will be the ones who will achieve success in this. As I said, it's important to identify international companies which could be interested in working with Georgia. Sorry, I don't know why the presentation jumped. It's very important as well to prepare sector-focused investment proposals. By investment proposal, I mean setting up the industrial zones, taking care of the infrastructure, making sure that there is labor force which is trained sufficiently for the companies, maybe even providing certain level of tax holiday. So it should be very sector-specific and company-specific proposals which should be provided to these companies. And most importantly, I think we should set a very ambitious and targeting communication strategy. I think even the fact that Georgia has managed to kind of manage this crisis of COVID so well is also one of the benefits and one of the proofs that the country has potential to withstand crisis. And God knows, in the last 20 years, Georgia has seen a number of crises, but in any way, we've continued growth, and we believe that this crisis could present real big opportunities for the country. So we are quite optimistic, and we believe that it's good time for investors to start digging into Georgia now and looking for opportunities. This is all what I wanted to say, so thanks a lot, and if there will be any questions, I'll be happy to answer. Thank you.
Otari, thank you very much for your very good and interesting presentation. Again, I will ask all of you, if you have any questions, there is an icon on the top right corner where you can post your questions, and at the end, we will try to answer them. So now let's go with our final presentation. So Anna, please, I give you the floor and go ahead.
Hello, good morning. I hope you can hear me well as well. First of all, let me thank my fellow colleagues for a very interesting presentations and insights. On this very positive note from Otari, on my behalf, Anna Kavtaradze, representing Trade and Supply Chain Finance of Bank of Georgia, let me provide you with the short updates on how bank managed with the pandemic, and also articulate the obstacles and the impact that generally trade and supply chain finance, as a very heavily paper and original document-based business, has coped worldwide, and of course the Bank of Georgia experience in a nutshell. Okay, so I hope you see the presentation now. Briefly about Bank of Georgia. Bank of Georgia is a leading universal bank in Georgia, a member of Bank of Georgia PLC, UK incorporated holding company, listed on a premium segment on LSE, and operates the following business segments, which are retail banking, corporate investment banking, wealth management, and having a subsidiary bank in Belarus, namely BNB Bank. Banks has a systemically important financial bank is in Georgia, and a leading market position by assets, loans, and deposits. Strong brand name recognition and retail banking franchise is a unique composition for the bank. Sustainable and high profitability has been a strategy of bank over the years and continues to be despite the pandemic, with an average ROE of more than 20%. Has a very resilient credit profile, has high standards and transparency of the governance. And as mentioned earlier, we are a listed bank and included in the FTSE 250, and continue to be included in a global responsible investment index, FTSE for good. Today, you will all agree that we have been living in a very unprecedented times, and proud to say that the response to the new daily challenges faced by the management team and the Bank of Georgia colleagues, as well as its customers, simply underlines the strength and the quality of the bank's brand name and its franchise of the customer. Let me deal with this. Okay. In the short term, our performance and the balance sheet remains very robust. Asset quality is resilient, and with the pandemic-related incremental general provisions created, we are happy to announce that we still remain comfortable, and given our economic scenario stress testing assumptions, which were mentioned by my colleagues also in the previous panels. Also, what I would like to highlight is the Bank of Georgia Group is well positioned with the strong funding and liquidity and the capital resources, which are very important at the time of the crisis. I guess that the early actions taken by the government were the essential to what has so far been an extremely well-managed response to the pandemic throughout the countries. Which basically were covered by Hector and Otari in the previous presentations. But let me still provide you some insights and opportunities, as Otari has touched the basis of the opportunities of the local production in Georgia, which is very much related to the supply chain opportunities locally on the market. With the pandemic globally has been affecting the world, I would say, as mentioned again in the previous presentations, I'm very honored to have the panelists touching the main aspects of the outbreak in Georgia. The outbreak in Georgia has not been as severe as in many other countries. And Georgian government took significant early actions to reduce the spread of the virus, which included the early flight bans, very early flight bans, I would have to say, and closure of the schools and the businesses at a very, very early stage. As Vasil was mentioning, the slides are pretty heavy, so you will be able to download them, the details from the presentation. I will not touch the topics in very much detail. What I would probably like to add is the government actions that were taken, as well as the National Bank interventions very positively to support the economy and to support the banking sector. Important regulatory measures have been taken to support the banks, including updating the supervisory plan of the National Bank of Georgia. The anti-crisis stimulus plan included the social assistance packages for the individuals, together with the substantial support for the business, including the tax exemptions and the holidays, and various funding mechanisms for the businesses. With having said this, let me move the slide. Having said this, the bank has an important role as a systemic bank within the crisis. So the bank's priority was the health and the well-being of its staff and the customers. And I have to say that we have implemented a comprehensive BCP plan to ensure the priority, together with sustaining the long-term stability and profitability for the group. Throughout the period of the pandemic, all of the bank's main branches have remained open, and employees have been working in split shifts and where possible, of course, from home. And we were very proud that the bank managed to do this transition in a very short period of time and in a very effective manner. In a sense, I would say that we have implemented a number of changes to reduce physical interactions to mitigate the spread of the virus. And we actively continued the further development of our fully integrated digital strategy. It was, of course, and remains a very critical, important focus for us. And as we seek to digitize all our banking platforms, obviously this focus has remained substantially since the start of the pandemic outbreak. As we have been talking about the digitalization, let me jump into the topic, which is very critical for the global trade finance and in general for the global trade. As a leading bank conducting the trade finance operations over 2 decades and remain at the front of the trade and supply finance business developing in Georgia, the bank has been a flagship in the region and always have been a pioneer implementing new products for the market. Just recently, in 2019, Bank of Georgia commenced the transformation under its strategy of the digitalization, a traditional trade finance services into digital platforms through the supply chain finance product translation into the digital systems. And this was basically to support the SMEs and the corporates to do more and to give them more possibilities to do business effectively. This remains the core strategy for the trade and supply chain finance of Bank of Georgia. Very, very long-lasting and fruitful partnership with our member banks, which I see some of them attending today's session, and also the membership of IFI, TFP programs, both as an issuing and confirming bank over a couple of decades. Again, Bank of Georgia was always able to have a global coverage and the flexibility worldwide, and this continues to take place. As Otari said, we have gone through many crises as a country and as a bank, and we have always kept the stability and the profitability at the same time. So we are confident that this is a challenge we have to take, and there will be a positive outcome at the end of the story. Despite the various innovations I've been telling or I've been providing, and the developments bank has been going through in a very difficult, it was pretty difficult, I would say, to digitalize the trade finance business prior to pandemic, especially to push it throughout the cost effectiveness and through the IT resources. But of course, there was an understanding always that it was obviously something that needs to be done. But for the specific original document-related businesses, such as the physical interaction with the customer, like trade and supply chain finance has in general over the world, during the pandemic, we have ensured the continuity of our business. And since the very early stage, and it was in March, we have split from the office and home working locations, which was very uncommon for the world, for the trade finance, especially for the operations teams to do so. And we are proud to say that until now, only 10% of the trade operation team is located at the office and with the reshuffles, and the rest works from home as efficiently as in the previous times. Having said this, even the COVID-19 reveals the shortcomings of a paper-based trade system. Banks and the financial institutions are finding the ways to keep trade circulating. And that's basically what I've been saying, that we would never imagine that it is possible to work from home from trade finance. And I would say that the people who are attending the webinar coming from the trade finance base, they would also agree with me that it would have been impossible to imagine with the existing resources within even the very global banks to do the business from the operations teams on a remote basis. But we see that we are trying to find the ways, and we are managing as much as we can. Nevertheless, the problem being faced in trade finance during pandemic was and remains to be a paper. This has been a disruption always, and we knew that there would be some actions taken, and it was coming. But the question, I would say that it was when. And preliminary, I would probably take you through to the data which ICC Global Survey has just published recently subject and in a response to the pandemic, which basically says that more than 60% of the respondents to the recent COVID-19 say that the trade flows worldwide will decline at least 20% in 2020. To keep the business alive, many banks worldwide indicated that they were taking their own measures to relax internal rules on original documentation. However, not many respondents reported that their local regulators have provided support to help and facilitate ongoing trade. Trade is an important part for Georgia. So without significant regulatory support, the efficiency that we have seen, we would, from the National Bank of Georgia, it would have been very, very difficult as a standalone for the bank to succeed and to provide the effective resolutions and results which we have achieved during this couple of months. Sorry. So, what I can say that, I mean, I will not go through to the products which Bank of Georgia provides as a trade and supply chain finance, because it's basically all the products which the global banks and the large banks are able to provide with their expertise, who are the core players on the trade finance market, and they are listed on the left-hand side. On the other side, which I would like to take you through, is that immediate responses and the measures which Bank of Georgia has taken in order to mitigate and control the situation with the heavy paper-based trade finance profile. Bank of Georgia has implemented qualified signature immediately as a response and to basically minimize the physical interactions with the customers and its beneficiaries. Fine-tuned its digital filing and the catalogs for the transactions so that the remote working would have become more streamlined and effective. Introduce new digital solutions and the platforms to its customers for the supply chain finance to streamline the process and to minimize the physical interactions with the customer. Did not had any delays in payments or responses to its local or international counterparties, and remains to be at service and online as effective as prior to the global pandemic. The difficulties faced by banks are a function of the nature of the trade. I would probably have to underline this, and you would all probably agree. Many of the issues related to the paper-based business impacts in fact, basically originate from the client and then affect multiple stakeholders such as shipping companies, logistic companies, customs, and others. This highlights the fact that the bank-based solutions alone cannot solve the problem, the global problem for the global trade. Oops. So what I would probably like to underline here is that as a response, ICC, International Chamber of Commerce, has issued, as of May, a number of important guidances to help the banks to manage the COVID-19 related disruptions by adopting the application of its widely used rules, such as URDG, UCP, ISBP, and etc. for the key trade finance products. But still, there has to be a lot done. Important interventions and the guidances and the actions taken by the government, financial institutions and the regulators, and the International Chamber of Commerce to support the trade finance includes, but are not limited to, the topics listed here. In general, it is basically to facilitate fast-tracking adoption of the UNCITRAL model law on electronic transferable records, because this remains to be the biggest obstacle for the digitalization. We believe, having gone through many crises as a country and as a bank, that uncertainties created by the pandemic will drive the need and the demand to the trade finance products as usual. Because what we see that when risks increase, the demand for the trade finance products increase drastically. Hereby, despite the drop down in the global trade, we always see the balance of the trade finance product because the need and the requests are coming and increasing. Despite the fact that I don't have the figures of the bank at the moment, because it's a very early stage from my point of view to make any assumptions, I would say that we have not seen a drastic drop down in the transaction requests. We've seen that there has been an active support from the government. The infrastructural project has not been postponed or stopped. The only issues were probably the logistics and the delays from the documents due to the courier services, but this has been fixed very rapidly as well. So overall, what we would probably say that it is a positive sign. It was a very interesting experience to go through, but there have to be lessons learned. And these lessons learned are basically for all the counterparties involved in the trade finance, in global trade, agreeing that the more digitalized solutions have to be implemented. And it has to be not only local basis by single banks, but on a global basis by the regulators and the local governments to adopt the uniform rules for the digital trade. What I would probably like to underline once again is that one of the important aspects of supporting the trade finance, which is a mitigant of the trade, and the trade is a driver of the economy, is to reduce the risk weights for the trade finance products and to revisit the applications of Basel III to the trade assets. Especially by the smaller economies, because this is the only way to support the trade finance products to keep alive and to support as a risk mitigant tools to the global trade. I think you would be all aware that the WTO and ICC and IMF has issued the paper in respect to this support. And it's a very interesting reading, which you can download from the ICC website as well as the other guidances which the ICC has provided. On the last note, what I would probably also like to underline is that the global pandemic will have a long-lasting and profound effect on the world. It's obvious. And with the structural changes to the global economy, markets, industries, and probably to our everyday life. And to stay ahead of these changes as a leading bank in trade finance business and in general, a leading bank in Georgia, we will, of course, continue to monitor the developing the economic trends and to the developments in trade finance in Georgia, of a local distribution as well as a global market, and will definitely take the appropriate actions to, as usual, proactively manage the evolving circumstances. And of course, we will remain at your service and online as usual. Thank you very much for your attention. Thank you once again for the attendance. And without saying, of course, wishing you all to stay healthy and safe.
Anna, thank you very much for your presentation. So that's it in terms of the presentation. So we have we have two questions. And again, I repeat, if you have additional questions, now is the time to ask them. So from Vladimir, I think that this is for Anna. Could you comment on any restrictions, technical problems with the import of goods from the EU to Georgia due to the COVID crisis from your experience?
Thank you for the question. Can you hear me?
Yeah.
Thank you for the questions. Basically, if the question relates to the import, especially from the EU and any restrictions, we would not be seeing any restrictions as of now. And with the very favorable tax regimes and in general, the trade agreements with the EU, we don't see any issues. The only issue I would probably be underlining during the lockdown, it was the flow of the documentation related to the trade. And basically, it was more importantly, the negotiable documents, which were important to be delivered on time, like bill of lading and the other documents which had the title of goods. That was my main concern for that period of time, which we have seen as not a problematic, but a delay, and we would have seen it as a problematic if the lockdown would have continued for a longer period of time.
Okay, thank you very much, Anna. We have another question. I guess this is more directed to Otari. Which do you think are the main opportunities in Georgia for import substitution?
All right. Hello. So thank you for interesting question.
Did you hear the question?
Yeah, I heard the question. Yes. So it was a question related to the import substitution potential.
Yeah.
So what we think is that initially it's construction material, because we see that the government in Georgia overall has a pipeline of around $20 to $25 billion worth of construction projects in the coming years. So, and there was a special plan implemented a couple of weeks ago by the government in order to support the sector as well. So we believe that there will be huge demand for these products, and most of them are imported. So I think this is something very important. Additionally, we believe that food products can be something important as well, because even though we are an agricultural country, we still import a lot. Because one of the biggest setbacks or challenges for Georgia is the very low productivity that we have. And this is mostly related to the fact that the parcels which are cultivated in Georgia on average are much smaller than what we see even in the neighboring countries or European Union. So we need to work on this. So these are two, let's say, potential hits or potential sectors where we see this potential. Overall, also there are other sectors, but I think these two are the main ones now: construction materials and food products.
Yes, and from my side, from the bank side, I would only agree. We saw that the construction did not stop during the pandemic as well, but the demand for the materials was very high. So. And there was always an opportunity and the potential in Georgia to make the production of the construction materials. Therefore, it's a good opportunity now, and we assume that this opportunity will be utilized. On the agri side, it was always one of the core elements for the Georgia to develop, because again, it has a very good resources and potential. And with the current situation and the close down of the borders, we saw that it is very important. So that's also something which will be supported by the banks as well. And there have been some government guarantee discussions about supporting the agricultural development in Georgia.
And just to let me add something, that the Georgia overall in sector industries is exporting primary goods. For instance, we export wood, and then we import a lot of furniture, being it high quality or low quality. There is also a potential of producing more value-added products locally, and then even substituting import or even going to export. So there are a number of opportunities. Actually, Galt and Taggart is currently working on this study. As I mentioned, we are looking on two sides, which is production capacity growth, and on the other hand, the FDA attraction. So hopefully in the couple of weeks, we'll be able to publish this report. It will be available in Georgian and in English as well. So you will be able to get much more insight on this in the coming weeks. I do not want to spoil it.
Perfect. So thank you both very much for the answer. And
thank you. Bye-bye. Thank you.
Bye.